How's it going, investors? I'm Ari, and welcome back to the channel where we're talking all about value in dividend investing for the everyday investor out there. So if you're a value or dividend investor looking to journey with me, well, stick around because today's video is one that you are certainly not going to want to miss out on, with 7 powerhouse dividend stocks that are currently trading at or below fair value, and all of which are ripe for picking right about now, especially before the market is about to recover. Now, of course, we're going to go over those 7 dividend stocks, but just before we do, I want to get to talking about my portfolio, a bit of an update, and cover on a macro scale what's been happening in the stock market. Before we actually dive in, I want to make sure you go ahead and tap on that thumbs up button for me because it helps me grow this channel and get the word out there. And then most importantly for you is subscribing to the channel, because I certainly want each and every one of you on this journey with me. Now, investors, let's get right to it. Investors, for quite some time, my personal account was boiling just underneath $100,000 after having hit a high of around $109,000, meaning we've been experiencing quite a volatile market. Now, I know I haven't been alone in feeling those portfolio pains, but I am certainly, as of this moment, happy to be back above that $100,000 mark. My account is now sitting at $103,562.74. So I think it's certainly worth a quick analysis on what exactly has been happening in the market. Of course, as you know, I think macros matter the most when making investment decisions. So let's go back to last week when we had a wave of fear hit the market, with Republicans and Democrats fighting for congressional seats. And while Republicans were expected to sweep the floor and actually take over the House and the Senate, these midterm elections have been far closer than many of us actually anticipated. And why exactly do midterm elections matter? That's the big question. Well, in short, Republicans taking over the Congress in any way, shape, or form ultimately means that Biden's agenda and his ease in passing bills will not be so easily passed moving forward. That creates gridlock. And when gridlock comes about, well, it's not necessarily great for the average Joe, but for us investors, it's ideal because gridlock buys investors time in the market and certainty, something that we need. And historically, it's been proven that the stock market performs best when there are political divisions. And even more important news, it's the latest inflationary reading, which sparked the latest market rally. Inflation came in at 7.7%. Guys, this is huge. Now, personally, I thought it would come in around 8%, and a lot of economists out there were projecting inflation to come in around 7.9%. But here we are, 7.7% inflation, which means that all eyes and ears now will be shifted towards the Federal Reserve. And now we can certainly hope that they will actually pivot or relax just a tad on their policy in fighting inflation, hiking interest rates by perhaps 50 basis points as opposed to their aggressive 75 basis point hikes that they were executing on. Either which way, guys, we are about to get now to these 7 dividend stocks before the market actually takes off and we miss our shot in getting into them at these ripe buy-in prices. So the very first stock I want to talk about is Tyson Foods, ticker symbol TSN. Now, I want to give credit to where credit is due. My good friend and fellow YouTuber Colton from Financially Fit mentioned this opportunity the last live stream we were on together. After doing some research on it, it really piqued my interest, and I want to share it with all of you. Now, given Tyson is just an exciting opportunity, while it's down 25% on the year, trading for $64.11 per share, with a PE ratio at just 6, which is just insane to think about considering it's the world's second largest producer of chicken, beef, and pork, and exports the largest percentage of beef out of the United States. Meaning, well, despite all the recent volatility, the downgraded share price from multiple firms, and their CFO getting arrested for drunkenly barging into a random home and sleeping in some woman's bed, none of that really matters. Their balance sheet is squeaky clean, and you better believe that we're going to continue to devour chicken and beef, and for all those who eat it, pork. I mean, we're talking about a $23.88 billion market capitalized industry leader with hedge funds already beginning to double down on the position. And moreover, analysts who foresee plenty of upside potential here. Matter of fact, about 34.14% of it coming up to a share price of $86 per share. Also, just interestingly to note here, how a powerhouse is currently standing when compared to some similar opportunities out there. This one is to be fully taken advantage of, especially with the reliable dividend yield coming in at 2.72%. Moving right along to our second dividend stock pick of the day, I want to talk about a home run semiconductor investment. Now, it's been in business since the 1930s and has become a force not to be reckoned with. So let's go ahead and talk about Texas Instruments, ticker symbol TXN. Now, immediately, you're probably thinking about calculators. I know when I think about Texas Instruments, that's the first thing that comes to mind, but they were a powerhouse manufacturer of a wide variety of integrated circuits to sell on a global scale, which has led to their market capitalization coming in at $152 billion. And right now, the company has been struggling like the rest of its competitors, as it's down roughly 11% on the year, trading for $165 per share. Now, guys, currently their PE ratio is actually below 20 and trading at more of an attractive evaluation than most competitors. That PE is at 17.6. And given that an economic turnaround is in fact just inevitable with due time, along with supply chains that will likely be restructured and resolved in an ever-advancing tech world, a play like Texas Instruments will surely perform well over the longer term, which is why there is projected 7% worth of upside by analysts, with a target share price coming in at $176.59 per share. Now, on top of all of that, we can even build some more confidence when it comes to Texas Instruments by taking a look at what hedge funds are doing. And smart money is, of course, scaling up their positions with Texas Instruments. Now, of course, until we actually find ourselves in a healthier economy, Texas Instruments is right there to pay us out in a dividend, with their current dividend yield coming in at 2.83%. As for our third dividend stock, it is as old as telegraphs. And a matter of fact, it was originally founded as American Messenger Company, specializing in, well, telegraph delivery, but has modernized over time. We now know this company as United Parcel Service, or more popular known as their ticker, UPS. Now, since their founding in 1907, UPS has not only been able to dominate the logistics space, it's the world's leading shipping carrier, and with e-commerce only becoming more of our norm, UPS is very well positioned to just continue to be very profitable. All in all, UPS has a current market capitalization of $146.32 billion, but it certainly hasn't become immune to market swings. I don't think any company has been, but it's actually down right now with recessionary fears looming and their profits down from a reduction in overall consumer spending, resulting in less shipping demand. So we can see that being a direct hit to their overall stock share price, falling by 21% on the year. It's currently trading for around $165 per share. But this opportunity should certainly be embraced because their PE ratio is currently right now at 13.2, prompting hedge funds to take full advantage of a very steady and reliable investment for the longer term future. And with shipping demand likely to bounce right back when the economy does so, there you have it. Millions are being poured into UPS by smart money. Now, analysts are also confident in a recovery, with a share price coming up to $194.38 per share. That's roughly 18% worth of upside. Now, until UPS actually recovers, there is, of course, that dividend coming in at a dividend yield of 3.3%. Coming up on our fourth dividend stock, I wouldn't necessarily say that this one is heavily discounted, but it's on the list for those of you who are looking to actually pad your portfolios up with very safe dividend investments that deliver through on a ton of reliability. Now, this particular play is a utility company, and I want to break down Consolidated Electric, or Con Ed for short. That's ticker symbol ED. It is one of the largest investor-owned energy companies in the United States, providing electric services to over 3.3 million customers, as well as over 1.1 million customers with gas and electric services in and around the New York City area. So just take a moment to take that in and think about that. With some bias as a former New Yorker, they service one of the greatest cities in the entire world, and unless New Yorkers just decide to essentially back out of paying their gas and utility bills and go back to the Stone Ages, well, this monopoly of an electricity play is going to just deliver through on dividend after dividend. They have a market capitalization of $31 billion, and amidst market volatility, they've only fallen slightly by 4% on the year, trading for $87.67 per share. Their current PE ratio right now is just 18.5. Now, it really may not be such a terrible time to begin padding up your portfolios with safer plays like Con Edison to quell some of your recessionary fears. But even if we are to avoid a recession, which I personally think isn't likely, Con Ed is a solid buy and hold type of investment that you can invest into confidently. So let's take a look at what analysts are saying. We can see here that there is some upside with a high stock share price coming in at $90 per share. So not too shabby, and ultimately we could just kick back and collect on Con Edison's dividend, coming in at a dividend yield of 3.59%. Next up, I want to jump into the healthcare sector, and for those of you who follow my channel pretty avidly, you can relax. I am not going to be talking about Johnson & Johnson, but certainly, in my opinion, the runner-up here is a powerhouse of a healthcare investment, which is AbbVie, ticker symbol ABBV. It's also a biotech company that was founded in 2013 after a spin-off that has become, in my opinion, just as powerful as J&J. And since their founding, has a market capitalization at this point of $262 billion after delivering some leading drugs to the market like Humira, which has been and remains the company's top sales generator. Now, AbbVie is not actually down on the year. It's trading for just under $150 though, but that PE ratio is below 20 at just 19.8, and should a recession hit, an investment into a play like AbbVie will surely just continue to deliver through on profitability for years and decades to come, in my opinion. Now, we can also see hedge fund after hedge fund taking full advantage of an opportunity to pour millions into a healthcare giant like AbbVie. And moreover, analysts are also favoring the stock with upside potential projected and a share price coming in at $150.75 per share. Now, until it reaches and surpasses analyst expectations, we have that dividend of theirs that we can collect on. So relax, take a breath, and collect on that 3.81% dividend yield. Coming up on our second to last dividend stock worth your attention right now is Amcor, ticker symbol AMCR. Now, it's a lesser known, probably less sexier, under the radar type of powerhouse of a dividend investment. Amcor is a global packaging company, meaning they produce all of the packaging for our everyday products, from rigid containers and cartons to closures for food, beverage, pharmaceuticals, medical devices, and personal care products. So just talk about an essential business to our everyday lives that we often don't even think about. That's Amcor. And given the current economic backdrop, leaving a lot of companies cutting costs and moreover just less overall consumer consumption, Amcor is on the line of fire here with their share price certainly impacted. It's down just about 5% on the year, trading for $11.02 per share. Now, Amcor has a $16.71 billion market capitalization. While the company may not explode with insane growth, analysts do foresee upside potential with Amcor coming back up to $12.86 per share, which, think about this, guys, that's 16% worth of upside. And of course, while you do so, Amcor shells out a dividend coming in at a dividend yield of 4.28%. And finally, last but not least here, we have a dividend stock that I personally have been loading up on recently. It is Stanley Black & Decker, ticker symbol SWK, which is the world's largest tool manufacturer, manufacturing industrial tools and household hardware on a global scale, with 50 facilities in the United States and over 100 facilities worldwide. Now, since their founding in 1843, Stanley Black has only dominated its industry and has brought a multitude of powerful brand names to consumers, from DeWalt to Paladin and Craftsman, just to name a few. Now, personally, guys, I'm quite baffled that Stanley Black is not exactly being talked about a whole lot across YouTube and the dividend investor community. And while everyone is pouring money into Lowe's and Home Depot, I say go right to the source, guys. Stanley Black is their supplier, especially as right now Stanley Black is down by 60% on the year, trading for $73 per share. That's down from $200 per share at the onset of the year. This is almost a no-brainer. And while it certainly may take some time for Stanley Black & Decker to come back and recover, I'm very confident in a massive comeback the moment mortgage rates come back down, home sales go back up, and of course DIY projects are more affordable. I mean, guys, we're talking about an $11.32 billion market capitalized business currently trading at a PE ratio of just 8.4, which prompted a lot of hedge funds actually rather recently to just begin pouring money into Stanley Black & Decker and remain long on their investments for that comeback. But that isn't necessarily all. We even see insiders buying more shares of their own company, which is a very promising sign for us retail investors. Now, simply put, when smart money and insiders are on the buying end, well, my confidence is of course restored. As for analysts, they're also foreseeing upside, 11% worth of it, coming up to a stock share price of $82 per share. As we await the economic recovery that we're all waiting for, we will just be able to enjoy this Dividend King's dividend coming in at a dividend yield of 4.14%. Now investors, there you have it from Tyson Foods, Texas Instruments, UPS, Con Edison, AbbVie, Amcor, and Stanley Black & Decker, the 7 dividend stocks that I think are certainly worth your attention right now to, at bare minimum, add to your watch list as buy and hold forever type of holdings based on their current market valuations. Now, just before we get going, let me know your thoughts on any or all of these dividend stocks by simply dropping a comment down below. Moreover, if you actually have your eyes on different stocks right now that you think are even better buys, leave a comment down below. Be sure that you also perform all of your due diligence before making any major investment decisions, because guys, I am not a financial advisor. I'm just here on YouTube sharing what I'm personally looking at with all of you and hoping you're joining me on this journey. So with that said, be sure to actually tap on that subscribe button for me. I want you on this journey with me. And moreover, if you've learned something new, if you've taken away something from this video, tap on that thumbs up button. And until the next video, guys, I will see you all there.